so Northwestern Mutual is the #1 life insurance company by market share. And so what that means is you've got individuals who buy life insurance and then they pay premiums to the company. And those premiums, and we get about $2 billion each month in premiums, we invest it in what we call the general account. So, and that general account is what we do institutional investing in. So that's about $300 billion in terms of size. You know, in terms of institutional investing, why that's important is because through that investing, we're able to pay dividends to our policy owners. So in 2024, we announced the largest dividend in the history of the company at $7.3 billion. And we are 3x the size of our nearest competitor in terms of the dividend payments that we've made. What makes institutional investing unique at Northwestern Mutual with the general account? The first is because we are we're one of the 5 companies that's AAA rated. So we have by Moody's, so we're very solid from a financial strength perspective. We're able to invest in more risk assets. So if the industry average is about 11%, we're at 18% in terms of risk assets. The second is, in terms of private assets, our portfolio is made up of 45% of private assets. So that's private credit, private debt, real estate. And we're one of the only companies that I know of, at least, that invests from a total return perspective versus a book yield. So from a total return perspective, what does that mean? We actively manage our portfolio and we're able to invest in opportunities depending on how the markets are doing. When you're on a book yield perspective, you're not able to do that. So that generates a lot of value, which then goes into paying dividends to our policy owners. Yeah, so I mean, in the most basic sense, you know, retail investing is about individuals investing their own money in the stock or the bond market. And you know, retail investing from a market perspective, it's about 35 trillion. But what's more interesting is how we define a retail investor when it comes to the alternative space, the private equity space, right? That particular retail investor is more sophisticated now than popular belief. And why are they more sophisticated? They have access to information, they've got personal insights, they've got dynamic tools and capabilities to inform them about investing in general. They've also seen, let's say in the last 20 years, 19 out of the 20 years, private equity funds mostly have outperformed public stocks. So they want in, right? And that retail investor is the one that I think there is an opportunity as you think about the next 10 years. You've got 9 trillion in retail investing. So I think the definition of a retail investor in the most basic sense is, you know, anyone wants to invest, but from a private equity alternatives perspective, it's that sophisticated investor who wants to invest like an institutional investor. The appeal is just because of the returns, right? If you just look at the historical returns, there's major appeal based on public stock market sort of returns versus what's happened in the private equity space. So there's this what I call FOMO, fear of missing out. They want a piece of the pie. They've also seen institutional investors really use alternatives as a strategy for diversification and optimizing their portfolio. But you know, I think from a GP perspective, you've got to be very cautious about a retail investor and what is a suitable retail investor, and I'll tell you why. First, liquidity risk, right? So this is not about buying a stock or selling it in minutes. This is about investing in a private equity, which has a longer duration, let's say 5 to 10 years. So if you need access to liquidity, it's not something that can happen easily. So there is that liquidity risk. So the retail investor needs to understand that. The second is higher minimums, right? Most private equity funds, they're looking at 5 to 10 million in terms of commitments. Some have come down to about $250,000, but this is not a product for masses. So that's the second. And then of course, higher fees, right? 2 and 20, you've got 2% on your assets under management and 20% on the returns. So when you think about when it's suitable, it's the retail investor that this is suitable for is a qualified investor that has ample liquidity and doesn't need access to that cash immediately. And I think that's very important. And I think as I summarize this particular point, I think the most important thing is trust and transparency from a GP perspective in terms of what retail investing is and what investors are getting into, I think is important because of all these challenges. First and foremost, let's start with the positive. I think given that there is this sort of 9 trillion of opportunity from a retail investment perspective, I think this is untapped potential for GPs. Having said that, I think this is not a gold rush situation. I think there are some risks and challenges that GPs need to understand. So one of them is, again, what I meant by who are good, suitable retail investors. This is not one where you can just open the door, just allow anyone in, and then if they need access and they're not the right fit, it's not great for the organization. So that's the first. The second would be around the fact that it's a lot more work for a GP. Right from like setting up your infrastructure, reporting. So think about it. Now you're going from 100 investors to potentially 1,000 or 10,000 investors. So the job gets to be more complex. I think the third thing, from a retail investor perspective, they're expecting a seamless experience when it comes to onboarding, subscribing, interacting with a platform. And so GPs have to be open to investing in technology and those customer experiences. And when you do all of that, you could potentially be getting into a loss leader kind of situation till you scale up. So that's another risk that, you can't go in with a rosy lens saying that it's all going to be great because we've got this 9 trillion. So I think those are some of the challenges a GP needs to overcome.